Welcome to the deep dive. I was reading some really fascinating research recently by Zuyao Teo and Claude Sonnet, and it just completely made me rethink how stock markets actually function for us, the individual investors. They call it this great disconnect. So today, that's what we're diving into, what equity markets really are. We want to challenge that common idea that you're just buying a piece of a business.
Yeah, it's interesting because traditionally that's exactly what equity ownership meant, right?
Okay.
Shareholders got dividends,
Yeah.
actual cash from profits, and they had real voting power, a direct link. But look at today's market, especially for individuals. That picture, it's changed a lot. Think about huge companies, Apple, Google, Tesla, Amazon for a long time. They pay tiny dividends, if any. And voting power. For the average person holding shares, it's basically become meaningless. All the power is with the big institutions and founders.
That sounds quite different from the textbook definition. So, if that ownership aspect is so weak, what are we actually doing when we trade stocks day to day? I mean, once a company has its IPO, its initial public offering, the daily ups and downs of the stock price, that doesn't directly affect the company's bank account or operations, does it?
No, not directly. That initial IPO money goes to the company, sure.
Yeah.
But after that, the trading happening on the secondary market, that's where most of us operate, it's really just shares changing hands between investors. It becomes what some call a greater fool scenario. Basically, you make money only if you find someone else, another fool, willing to pay more than you did for the exact same claim.
A greater fool scenario. Okay. So if that's the dynamic for many people trading, what does this whole system start looking like? The picture Teo and Sonnet paint, it sounds less like investing in businesses and honestly more like something else entirely.
It does edge towards a kind of casino analogy, doesn't it? A massive global casino. Individual stocks become the games, and people are betting on price moves, driven by sentiment, by momentum, by speculation,
Mm.
often disconnected from the underlying business value.
A casino. That's a strong image.
Well, think about it. Like any casino, the house tends to win consistently. Brokerages taking commissions, market makers using the spread, those high-frequency trading algorithms, they profit from the activity itself. And the reality, unfortunately, is that many individual retail participants, they tend to lose money over the long haul.
So even dividend stocks, are they just like the free drinks?
Huh. You could sort of see it that way, yeah. They're like the little perks, the complimentary drinks, or maybe a buffet voucher. They're nice. But the main event, the real gamble where most money is made or lost for individuals, is on that price going up or down.
Okay, that's provocative, but maybe a bit cynical. Isn't there still value? Especially when you compare it to, say, bonds or commodities, those seem different.
They absolutely are different, and that's a key contrast. Bonds represent a loan, clear terms, interest payments, you get your principal back. It's a defined financial relationship. And commodities, oil, wheat, gold, they're actual physical things. They have inherent use, and their prices are tied, pretty directly to real-world supply and demand. Much more tangible.
Right. So this leads to what Tao and Sonnet call the cognitive disconnect then.
Exactly. There's this story the financial world often tells you: invest in stocks, own great companies, build wealth.
Yeah.
But the activity for many retail investors feels much more like bet that this price will go up because other people seem to think it will. It's often about sentiment and momentum.
Mm.
And just recognizing that difference, that's vital for you to make smarter choices, to really understand the risks you're taking.
But we should add some nuance here, right? It's not like the stock market is useless. From the perspective of the companies themselves or big investment banks, the share price does matter a lot.
Oh, absolutely. For institutions, it's a critical tool. A high stock price makes it cheaper to raise capital, easier to buy other companies using stock, maybe get better loan terms. It has real strategic value at that level. The disconnect happens because you, the retail investor, are invited into this, let's say, institutional arena.
But without the same information or influence or, frankly, the same strategic goals as the big players.
Precisely. You're playing a different game, often with different rules or at least different stakes in information.
So understanding that dual nature seems key. It's one thing for institutions, another for individuals.
Yes. Understanding that the equity market can be both a place for legitimate capital allocation and a venue that often functions like a speculative casino for retail participants that allows you to participate more wisely or decide how you want to participate.
So maybe the final thought for you listening is this. The next time you look at a stock price ticker, just ask yourself, am I really investing in the nuts and bolts of this business? Or am I placing a bet in a very sophisticated, very convincing casino that just happens to be themed around business? Something to think about.